Welcome back to the show, and today we're going deep into one of the biggest undercurrents shaping the entire crypto market right now. The escalating tension between the US Securities and Exchange Commission and the digital asset world. It's a clash that has been building for years, but over the last couple of weeks, something has shifted. The tone has changed, the language has changed, and the direction of regulation feels like it might finally be entering a new phase. Whether that turns into clarity, conflict, or compromise is still up in the air, but the decisions that get made from this point forward will shape the entire industry for years to come. So let's break down exactly where we are, why this moment is different, and what could realistically come next. Thanks for the incredible support. We're now only about 80 ratings away from the next 50 XRP giveaway milestone. All we need is you to keep rating the show 5 stars. We're also giving 10 XRP to the comment of the week and 5 XRP to a second listener, and we'll reply to your comments to collect your addresses. We're doing this every Friday up to Christmas, so keep the ratings and comments coming. Even a quick emoji keeps you in the running. Now let's get into it. Over the last decade, the relationship between the SEC and the crypto industry has moved through several phases. There was the wild experimentation phase of 2016 and 2017, where regulators barely had time to catch their breath as ICOs exploded and billions poured into tokens that didn't even have a functioning product. Then came the crackdown phase, where the commission decided that much of what had been happening in the space clearly fell under securities laws, and it moved aggressively to bring the market back under the umbrella of existing rules. After that came the stalemate phase. Long court battles, unclear guidance, and a regulatory environment where companies didn't really know which rules applied to what. But now, with new leadership conversations happening, with election dynamics shifting the tone, and with massive institutional money flowing into approved Bitcoin ETFs, we're entering something closer to a crossroads. What triggered this shift is a combination of factors, but the most important is this. The SEC has publicly acknowledged it is reviewing how digital assets should be classified. That might sound like a small piece of news, but in regulatory terms, it's massive. When a regulator that has spent years treating most tokens as unregistered securities starts saying openly that the current framework may need updating, that means the ground is moving. It doesn't mean leniency. It doesn't mean approval. But it does mean the door is opening to something other than blanket enforcement. Reuters reported earlier this month that the SEC is now actively considering formal classification criteria, and that alone changes the entire path forward. At the same time, the Commission has begun issuing no-action letters in specific circumstances, which is their way of saying, under certain conditions, they will not enforce securities laws against a given token. One recent example was the Solana-based Fuse token. This is not the SEC blessing the token. This is not approval. But it is a signal that the Commission is realizing not every digital asset fits neatly into a 70-year-old legal definition. This is where the clash begins to get interesting, because while the SEC is softening its language in certain areas, it's also maintaining strong enforcement pressure in others. The message is mixed. Some tokens may be fine, some tokens may be securities, some may need new frameworks. And in the meantime, the Commission continues to litigate cases that have been dragging on for years. It's confusing for investors, exhausting for builders, and frustrating for companies trying to operate legitimately. But even in the chaos, there is an underlying truth. We are finally reaching a point where something has to give, because the way things stand right now simply isn't sustainable. One of the clearest signs of that came from an analyst at Bernstein this week, who said, "The SEC is reaching the limits of what it can enforce without new rules. The courts are slowing down the Commission's approach, and the market is too large to rely on enforcement alone." That comment essentially sums up where we are. Court rulings have challenged parts of the SEC's authority. Congress hasn't stepped in with clear legislation. And meanwhile, institutional investment keeps pushing deeper into the ecosystem, with firms like BlackRock, Fidelity, and VanEck becoming some of the biggest holders of Bitcoin through ETF structures. Think about that for a second. 10 years ago, the SEC would not have dreamt of approving a Bitcoin ETF. Now it has approved multiple spot ETFs, reviewed Ethereum products, and is weighing a new approach to classification. That is seismic regulatory movement in a very short period of time. But what's really creating tension right now is the question of consistency. The market wants to know, what drives the SEC's decision-making? Why is Bitcoin clearly treated as a commodity? Why is Ethereum moving slowly toward the same treatment? Why are some tokens seen as securities, while others exist in a gray zone? And why does it take lawsuits for clarity when clear frameworks would solve the problem? Before we answer that, we're going to take a quick break for our sponsors. But stay with us, because after the break we're getting into the scenario analysis. What actually happens if the SEC continues down its current path? What happens if it changes direction? And what happens if political pressure reshapes the entire landscape?
Avoiding your unfinished home projects because you're not sure where to start? Thumbtack knows homes, so you don't have to. Don't know the difference between matte paint finish and satin? Or what that clunking sound from your dryer is? With Thumbtack, you don't have to be a home pro. You just have to hire one. You can hire top-rated pros, see price estimates, and read reviews all on the app. Download Thumbtack today.
What can 160 years of experience teach you about the future? When it comes to protecting what matters, Pacific Life provides life insurance, retirement income, and employee benefits for people and businesses building a more confident tomorrow. Strategies rooted in strength and backed by experience. Ask a financial professional how Pacific Life can help you today. Pacific Life Insurance Company, Omaha, Nebraska, and in New York. Pacific Life and Annuity, Phoenix, Arizona.
Okay, let's get straight back to where we left off. This is where analysts expect the real battles of 2025 to unfold. The SEC has said it will consider crypto token classification, but that process could take months or even years. In the meantime, companies continue launching new tokens, developers build systems that don't fit neatly into securities law, and global markets evolve faster than American regulation can adapt. Europe now has MiCA, a dedicated regulatory framework. Hong Kong is onboarding crypto ETFs. Singapore has clear rules. Even the UK is speeding up its digital asset oversight. The United States is falling behind, and people in the industry know it. An analyst from Framework Ventures said this week, the US risks losing its leadership position if it doesn't modernize its approach. Crypto talent is geographically mobile, and capital follows clarity. That's the reality. Tech doesn't wait for regulation. Regulation has to keep up with innovation, or it becomes irrelevant. So where does this clash go from here? The short-term expectation is that the SEC will continue its targeted enforcement, going after fraud, insider trading, and tokens that are clearly marketed like unregistered securities. But that's the low-hanging fruit. The bigger question is what the Commission does with the huge middle group. Tokens that are decentralized enough to not be traditional securities, but not decentralized enough to be commodities. That's the zone where most of the market lives. This is why classification matters so much. If the SEC develops a true multi-tier framework, not just security or not a security, but something more nuanced, then the market finally gets clarity. Tokens could be graded by decentralization, by governance structure, by distribution model, by use case. There could be specific disclosures required for certain tiers. There could be exemptions for decentralized networks, similar to how commodities markets operate. And if that happens, the market becomes investable at a scale nobody has ever seen. That's why institutional money is still pushing forward despite the uncertainty. They know that clarity is coming eventually, and when it does, the first movers will be in the strongest position. There's a reason BlackRock didn't stop at Bitcoin ETFs. There's a reason Fidelity is exploring staking products. There's a reason large funds are accumulating infrastructure, and L1 tokens quietly on the side. They're playing the long game. All right, let's jump into the scenarios, because this is where the deep dive gets interesting. The first scenario is the most likely in the short term, and that's regulatory drift. The SEC continues making small adjustments around the edges, reviewing classification slowly, issuing occasional guidance, and maintaining enforcement pressure. The market doesn't get perfect clarity, but it gets enough to keep moving. Bitcoin and Ethereum continue enjoying commodity-like treatment. Large-cap altcoins operate in a gray but manageable zone. Smaller tokens face more risk. It's not ideal, but it's stable enough for growth. The second scenario is a regulatory pivot, where either political pressure or internal recognition pushes the SEC to adopt a more flexible framework. This is the outcome analysts are hoping for. Under this scenario, the Commission introduces multi-tier classification, offering different rules for decentralized networks, utility tokens, governance tokens, and security tokens. This approach mirrors Europe's MiCA in some ways and instantly unlocks billions in sidelined capital. It reduces court battles, it gives exchanges clarity, and it allows builders to innovate without fear of retroactive enforcement. Then there's the third scenario, congressional intervention. This is the least predictable, because it depends on politics, but it's not impossible. Multiple bills have already been drafted to clarify crypto regulation. They haven't passed yet, but if one does in 2025, it could dramatically reshape the landscape. A congressional mandate that splits oversight between the SEC and CFTC, or creates a new digital asset regulator, would change everything overnight. No matter which scenario plays out, the market is watching closely. And here's the key takeaway. The clash between the SEC and crypto is reaching a point where it can't remain unresolved. The industry is too big, the money involved is too large, the technology is too entrenched, and global competition is too intense for the US to keep operating in this half-regulatory twilight zone. Something has to give. We're heading into a period where clarity, real clarity, might finally be on the horizon. And whether that clarity comes through evolution, correction, or political pressure, it will define the next decade of crypto innovation. Make sure you're following the show, make sure your notifications are on, and as always, we'll see you at the top.